Welcome to Business Middle East. This week we are looking closely at the implications of the U.S. Federal Reserve ending its quantitative easing program. It's being wound down as the Fed gets ready to take off the training wheels and let the U.S. economy ride on its own. While the Fed feels growth may be sufficiently back on track, so that kind of stimulus is no longer needed. Some investors in Europe and the Middle East are not so sure and worry about the consequences to economies and markets.
The Federal Reserve is set to announce the completion of its third round of quantitative easing. That consisted of printing money to buy long-term government bonds and bonds backed by home mortgages. If the US economy then continues to grow and financial markets remain stable, the Fed will consider raising interest rates, probably late next year. After the financial crisis, the Fed used quantitative easing 3 times to keep borrowing costs low for home buyers and stimulate the economy to create jobs. QE1 in 2010 injected just over $1.5 trillion into the economy, followed by QE2 in 2011 totaling $600 billion. QE3 in 2012 began at $40 billion per month, rising to $85 billion a month. Since January, the Fed has been trimming its bond purchases, and if, as expected, they end this month, the total will have been $789 billion US dollars. During QE3, the US economy has grown. Unemployment fell below 6% of the workforce, and inflation rose slightly. All that cheap money boosted markets in the Middle East, Europe, and Asia. However, when the Fed ended QE1 and QE2, financial markets slumped, and investors are worried that that could happen again.
To find out more, we are joined from Abu Dhabi by Nour Eldeen Al-Hammoury, Chief Market Strategist at ADE Securities. Hello, Nour. Is the U.S. economic recovery firmly enough established to continue without the Fed's stimulus? And what about Asia and Europe?
Well, there is some improvement, that's definite, but we can't say that it's recovering or may continue, or it's as everyone's hopes. The GDP is growing based on the inventories, which doesn't mean that the sales are increasing. The slack in the economy remains, and so far there is no clear strategy by the Fed or by the government on how the slack will be solved. So, moreover that, the slowing down in Europe and Asia will be something to consider, as the U.S. economy is unlikely to grow on its own.
Middle East markets have certainly benefited from the Fed's stimulus measures. If there is no more cheap money from quantitative easing, will that restrict their growth?
It's not the Middle East markets only. It's the global market, and especially the emerging markets. This year, Dubai, let's say, for instance, Dubai, or as an example, Dubai stock market was one of the best performers in the world. However, we've seen some declines at the end of the year. These markets are, again, sensitive to any events. However, the Middle East markets may benefit, again, from what's happening in Europe and the outflows that is happening in Europe. And also, don't forget that this region also opened its door for foreign investors. So with the Federal Reserve ending the QE, we might see some declines again. Yes, this might happen. And if the global slowing down continues, the global market, including the Middle East, may continue with the current downside correction.
The next big move from the Fed would be raising interest rate. What could happen then?
Well, the global markets has already priced in such a move. However, we are looking at the bonds market lately, and so far traders and even clients not sure that the Federal Reserve will be able to raise the rates, and the U.S. 10-year yields remain lower despite all the talks about raising interest rate next year. However, don't forget that the housing market, even so far, does not support such a move anytime soon.
Thank you, Nour, for joining us.
Thank you for having me.
That ends this edition. For more business news, you can always visit Euronews.com. Thank you for watching. Have a nice week.